Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, April 17th, 2021. And our top story today, valuing ESG, doing good or sounding good. Well, joining me now to discuss this and a lot more is Professor Brad Cornell of UCLA's Anderson Graduate School of Management. Brad, so great to see you. Thanks so much for joining us on the program this morning.
Glad to be here.
So I want to talk to you about this. You and a colleague from NYU Stern wrote a great paper on valuing ESG, and I just couldn't help but wanting to dig into this with you. What was the thesis of the paper, and what do we need to take away from it?
Well, it was a relatively lengthy paper, but I think the main thesis was that ESG is getting oversold from the standpoint of investors. And they should be very careful jumping on that train, particularly if it involves their own retirement funds.
Yeah, this is, I think, becoming a bigger evolving issue is what is ESG and how do you validate that an investment manager, either that you're selecting or an investment manager that is part of your retirement plan, is actually following these ESG mandates, and is it good for your portfolio? How do you see it, Professor?
Well, that's a multi-part question.
Sorry, we only have 10 minutes. I'm so sorry.
Well, let me break it down. The first one is, it's very difficult to know what is ESG. For example, is Tesla an ESG auto manufacturer? Well, most people would say yes. I mean, they're the innovator in electric vehicles. But hold on a minute. Their major market now is in China. In China, 60% of the electricity comes from coal. And the manufacturing of EVs, because of the batteries, requires a lot of electric power, and that comes from coal. So basically, Tesla in China is a coal-powered company, and it should be very low on ESG. On the other hand, as China changes, as it develops, as it goes more to renewable power, then Tesla becomes more ESG. And that's just one example. So even if people are being fair and honest, it's very hard to tell what is an ESG investment.
So when you're walking through, if you're an individual investor, and look, the ESG is in all the major literature, it's covered on regular, all the big business programs, covered probably in major newspapers. How do you kind of sift through? What are some ideas to sift through if you're an investor trying to figure out whether or not something is appropriate and whether something appeals to your value system? Because after all, it really isn't based on the individual's value system.
Yeah, that's correct. And there are two things there. One is, what value system do you have? Like, suppose you're very concerned about internal combustion engine cars. Then you may want to invest in battery companies or electric vehicle companies, for example. So that's one issue you face. The other issue you face, and this to me is the most fundamental one for retirement people, is how much are you willing to give up in the way of expected return on your portfolio to have what you think is a socially appropriate portfolio. For example, would you take 6% brown or 5% green? People have to answer that question, and they don't realize that they have to for a reason I can get to in a minute.
Yeah, it really, to your point, it really is a personalized decision. I'm not sure that, again, the investors are caught up with this. It's the latest. I don't want to say latest fad because it's grown significantly, and it probably is more than a trend. But you get caught up in I'm against fossil fuels, or I'm against using animals for testing or something like that. But and I've always dealt with this when I was an advisor. It's like, how do you look at other aspects of your life to try to make sure that you're in complete alignment? Because you could be against animal testing, but be wearing leather shoes or have leather in your car, right? So and that's an extreme example of maybe of hypocrisy. But you've really got to make sure that things are aligning with your value system, I guess.
And that's really hard to do. unless you know how a product is made and where it's made and how it's shipped and so forth. That's an awful lot to ask of normal people.
Now, what about, we look at the labels. You look at an average mutual fund, and you can look at how it's weighted in terms of its portfolio to equities, to different types of equities, mid, large, small. You can look at the expense ratio, the amount of risk, all those kind of factors that we look at. But there's not really a good way that I can tell, and maybe of looking at some of these factors, like by actually looking at the labels.
At this point, I don't think there is, no. And now the SEC is wondering whether it should have new types of disclosures, but that's a real mixed bag. Like take my Tesla example. What should Tesla disclose about the cleanliness of its operations and sales in China? And that's expensive. All these disclosure issues don't come free. They eventually come out of the pockets of shareholders, and that means retirees. So I'm not sure I want my companies involved in multi-million-dollar efforts to disclose exactly what their ESG rating is, if they could even do it after spending all that money.
Yeah, absolutely right. And what about the investment manager? A lot of asset managers getting into the ESG world, but they still maintain portfolio teams that don't dabble in ESG, right? So they've got one portfolio team, maybe they've got an ESG fund, but is there ever crossover or sharing of some of the analytical or portfolio management themes between portfolios? So, asset managers don't just run ESG funds, maybe some do, but they're in lots of different lines. And by the way, they're also fiduciaries within their fund. And so they have pensions and endowments and 401ks and individual investors and institutional investors as part of their fiduciary pool.
Well, a quote I remember when I was just beginning to study investment management, a friend who was working at Goldman Sachs in asset management put it this way. He said, asset management isn't about managing assets. It's about getting assets to manage. And there's a lot of that with ESG these days. It has been seen, I think, by asset managers as a way to get funds under management. And so they have this sort of a dual role where they say we're really ESG on the one hand, and then on the other hand, they're actually trying to beat the market with normal management techniques. And the two may not be consistent. In fact, Professor DeMotorin and I believe in many circumstances they are not consistent.
Yeah, absolutely. Yeah, I think in a lot of cases they're not consistent. And especially if you look at some of these benchmarks, and you look at what you're paying for this additional level of screening, because to your earlier point, someone's got to figure out whether Tesla, in your example, is ESG, doing it appropriate. So a fund company has to have a portfolio team, a dedicated team, a dedicated set of analysts to understand what the case is. There's a cost associated with that as well. Professor, if I could ask you, you're active at UCLA and teaching students. Is this a big issue for some of your graduate students that you're teaching, that you're lecturing and learning about? Is this a key theme for them?
It's become more important, yes. I'm teaching a new course with Ivo Welsh, another UCLA professor, entitled Climate Change, Energy, and Finance. And we're trying to bring them together, but with not so much of a moral overtone, to really look at it objectively as an economic and asset management problem.
And is it your sense that, are there any findings, at least initially, whether or not this is more of an economic and less of a moral issue, or can it be solved economically versus morally?
Well, let me show you what that conflict is. And I think that as a last point, this is maybe the most important one for your listeners, particularly your retirees, to understand. So let me do a quick example for you. Imagine two companies. I'm going to call one Exxon, and I'm going to call the other Nextera. Nextera is the green one, Exxon's the brown one. And suppose we go back a decade when no one was concerned about climate change, which is the E part of ESG. And the two companies were priced exactly the same. They were just energy companies. Then as time passes, Nextera, everyone becomes enthusiastic about it. They want to hold it. It's green. It's the right way. This Exxon, and I'm just using the names, I'm not saying those are the real companies. This Exxon is in oil and gas. It's brown. It's bad. Students want to divest. Well, in that type of world, the price of Nextera is going to be bid up and the price of Exxon is going to drop. But from an investment standpoint, it means if you buy Exxon, you're likely to get higher returns. And if you buy Nextera, you're likely to get lower returns. This notion, that's why Professor DeMotor and I said you can't have your cake and eat it too. If people really want to hold green stocks because they feel good about that, they're going to pay for it in dollar returns. And I think we need to pay closer attention to that.
Yeah, I think this is a bigger issue. It's growing leaps and bounds as more assets are flowing into these funds. Being able to understand where these funds invest and making sure the investor knows where he or she is putting their money is going to be important, and whether or not they're making money. Professor Cornell, it is a pleasure to speak with you. Really enjoyed the conversation, and we look forward to having you back on the program again very soon.
Great, and I'll be still at the Anderson School of Management. Yeah.
Thank you, sir.
Thank you, Jeff. Bye.
Thanks, Brad. And when we come back, we'll take a look at some of our best segments for the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. On Thursday, I sat down with Johns Hopkins Medicine's Dr. Michael Blaha to learn what's more important, fitness or fatness. Let's take a look.
Yeah, this is a great scientific debate, the fitness versus fatness debate. People are debating this all the time. And they go together, of course. Generally speaking, people who are more fit are less fat, but that's always not the case. So this is where the literature has started to investigate which is more important. And I would posit that the more important one of these is actually your fitness level. Your fitness level is more important in some ways than your fatness level. And what I mean by that is if you're a little overweight, for example, but you're fit, you actually have pretty good outcomes. Your survival and your cardiovascular disease outcomes are favorable. If you're normal weight but have very poor fitness level, actually your prognosis is not so good. So it's really more important to kind of strive to achieve fitness. Well, of course, while also managing your weight, but fitness is more important. You know, I always like to tell my patients is you want to do something where you break a sweat. People always ask me kind of what level of activity do I need to kind of improve my fitness? And that's my general first take. You have to break a sweat. That could be via brisk walking, hiking, running, jogging, a lot of different activities. But if you're just walking around, around the block, maybe in a social way, don't really break a sweat, I'm not sure that's really going to help your fitness that much. So I think you need to get up to the point where you break a sweat. That's a rough rule of thumb. And people always say to me, well, I've been exercising, but I'm not losing any weight. What I say to them is, well, do you feel like you can exercise more? Well, yes. Is your exercise capacity improving? Yes. Well, your fitness is improving, and sometimes the weight lags behind that. So sometimes you can be doing a lot of good for your body by improving your fitness before your fatness gets better. That's one of the key messages here. So even if you're not losing that weight, but you're doing that exercise, you're improving your overall health. So let's say you're a little overweight or obese and your fitness is not so good. And you start an exercise program and you start to exercise more. You start to improve your exercise capacity, but your weight hasn't changed yet. You might think, this isn't working. But I can guarantee you, if you check, and we've done research on this, check things like your triglycerides, as you mentioned, the inflammation level in the body. Those are going to be improving even before the weight improves. That speaks to why fitness is so important. You're doing great things for your body in a metabolic way, even before the weight changes. Now, you might see your weight redistribute. That's one of the most important things, right? You start to see your waist size get smaller even before there's big changes on the scale, right? Because you're going to lose that weight preferentially in your abdomen and that visceral fat that we think is the worst for you. So those early changes where your fitness is getting better, you might be losing a little bit around the waist, but only a couple pounds on the scale. If you checked a bunch of these other metrics, as you mentioned, the triglycerides, the inflammation levels, things, diabetes, or sugar levels, those are all going to be getting a lot better in concordance with the fitness changes. So yes, a lot's going on in the body, even before you lose weight. The best marker of your metabolic health as far as your body size is actually the waist circumference, as you mentioned. It's the fat, it's the weight, the tissue that we put around our waist, particularly as men, but also as women, inside the abdominal cavity, that's the worst for you. It causes the most problems compared to a little fat in your arms, for example, or around your shoulders. So it's actually the waist circumference that's the best. Now, getting on the scale and just measuring your weight, that's a good start too. But I tell my patients not to overemphasize that because that's going to be a lagging indicator of the benefit. But if you notice the little looseness of your pants around your waist, you just feel a little bit better there. That's the start of the process. You're starting to lose some of that kind of the most high risk fat. So the BMI is a nice thing. There's some other fancy ways of measuring these things, but just a simple kind of tape measure, or just your pants around the waist, or even just, you can tell just by putting your hands on your waist. That is a great indicator that things are starting to change. Of course, with diet, like everything, it's in moderation, right? I never tell my patients that you can't have this or you can't have that. There's no one food that's perfect. There's no one day that you can't splurge. It's about being consistent 365 days a year with a general diet pattern that's favorable, and you'll have good outcomes. So yeah, what I would summarize kind of the big things from this section that we just did was how important it is to achieve fitness, that just because you're a normal weight doesn't mean you're fit, right? You can actually be overweight and fit, and that's better than having low fitness. So you need to separate those in your mind. There's fitness and there's fatness. Fitness is more important. Fitness is important, even if you're starting to lose just a little bit of fat around the waist, really important. And then, diet, be consistent, something that you can stick with. When a patient says to me, I'm on a 30-day strict diet where I'm not having all my favorite foods, I'm a little worried because they're probably not going to stick with that. So something that you can stick with, 1 day a week, splurging maybe, fine.
And I also spoke with MillionAcres.com's Deidre Woolard about real estate investors betting big on a return to doctor's offices. Let's take a look.
Well, absolutely. I think all of us may have skipped some of our appointments last year, and I think a lot of us are going back to the doctor. And we also learned what telemedicine can and can't do. So a lot of people really experimented with telemedicine last year, maybe talking to their existing doctor or having a virtual appointment for the first time. And we learned that it's great for some things and not great for other things. And there are certain things that we just need to be in the doctor's office or the dentist's office. We can't do everything online. And so it's right now we're seeing really a return to the doctor's office and also an increase in elective surgeries as well. And that was something that stopped happening during the pandemic and now is coming back. And another trend that we're seeing is one thing that the pandemic did is it accelerated that focus on wellness. And that means it's not just going for your annual physical, but really thinking about optimizing your health. We're also dealing with this long tail trend that was, before the pandemic, is the aging of America and the massive, uptick in healthcare that we're going to need as boomers age. We all need more healthcare as we get older. Our boomers are in their 70s and starting to be in their 80s, and that is going to be a huge impact on health. But even in younger generations, we're seeing this focus on not just how do I stay healthy, but how do I become the healthiest person I can? What can I do? And we're seeing sort of this wellness and medical kind of merging, and that's really an interesting sector. But it's also something else, and that is the fact that there is more interest in other types of procedures like cosmeceuticals, Botox, fillers, things like that. Those are also popping up in malls, cool sculpting, things like that. So you're seeing more of those medical treatments rising too. I mean, there's been a lot of different studies about the rise in plastic surgery for both men and women, partly because for the last year, we've been staring at our own faces on Zoom and realizing what we might want to fix. And there's also an interesting trend that was happening before the pandemic is the sort of evolution of the medical campus. So instead of just having the one high-rise building, you have it almost looking a little bit more like a tech campus with a bunch of different types of offices there. So you go to your dermatologist, and then in the next building over, that your internist is over there, and really creating an entire system for people. One of the things that's happening in my market in Alexandria, Virginia, is the former Landmark Mall, which is one of those dying malls, is now going to be transformed into a healthcare campus. And that's going to create a whole neighborhood around it. And we're seeing that happen across the country because a lot of the procedures that we used to have done in a hospital are now being done on an outpatient basis or being done in a doctor's office. And that's changing things as well. But you have to also consider now, if you have a doctor who's doing telehealth, that also means that they're going to have a space with a big monitor with room for that. So that actually means that they may need more space. And I think one of the things we're talked about hybrid work, right? We're going to see hybrid healthcare. And that's the same kind of thing where maybe I go to the doctor, then I go get my blood work. I do all of that stuff and he sees me, and then we do the follow-up maybe via Zoom, and he gives me the results and we look face to face versus getting it over the phone, which is a little bit, it's a better experience for you if you can actually look at your doctor. And so I think that we're going to see an increase in the need for those types of rooms, and that's also and really integrating technology. One of the things that really fascinates me, I've talked to a bunch of people in the modular healthcare space talking about building healthcare individual rooms as kind of like a tech hub, so that when you're at the hospital or you're staying somewhere, there's a monitor in there already. It's already got sensors in it. So really healthcare and in-person healthcare is going to sort of embrace some of that technology as well.
And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to, then drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, all in one place, check out today's edition of our newsletter, The Morning Pulse, and of course, our website. We're back again tomorrow for BRN Sunday. I'll be joined by members of the media, academia, and financial services as we analyze all the news and information this week in a multitude of topics. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.